Hey, real estate agents, welcome to the Weekly Closer. I'm your host, Jeff Underwood, along with my co-host, Joey Sampaga, and we're excited to bring you some special guests with us today. We got Brian Kelly, loan officer with Barrett Financial, and Jordan Page, realtor with American One Luxury Real Estate. How you doing, guys?
Doing well, thank you.
Doing great.
Good. Hey, we're going to cover some interesting things to with regards to the market and how quick it shifted, and then some things about financing. I know these guys are going to share with us, so I'm really excited. But why don't we first jump into each one of you sharing with the agents that are watching or listening how long you've been in the real estate or mortgage world and what got you into it?
I'll go ahead and jump in. I've been in real estate for 5 years now. Started at a firm actually owned by a previous business of mine. He was a marketing client. I had a marketing agency with a partner, and I meet this broker who does extremely well for himself, and he was creating a e-course on how to be a successful real estate agent. And we're creating content for him, and I'm pulling all this into a course. And I'm looking at it, and through osmosis, I'm like, well, I could do that. I want to do that. And I got tired of being this wizard behind the curtain and decided to jump into real estate full time under that man as my mentor. And I've changed brokerages since, but he still remains a friend to this day. And I came to it kind of, I feel like in the opposite direction as most agents, where they come in from the real estate side and then they have to learn how to market, how to get clients, and how to really sell. I came from the marketing and sales background and then real estate afterwards. So it was kind of a reverse journey.
It's actually easier to learn real estate than it is marketing, in my opinion.
I think so. I think once you have the principles down, you can apply it to real estate.
Yeah, exactly.
When you had a front kind of a VIP pass there to learn it all then, because you're getting it all prepared, right? For this course. And then you're like, gonna just do it myself.
I had lunch with them one day when I first decided to do this. And I said, let me get this straight. You meet people, you make lifelong friendly connections, you help them with some of the biggest transactions of their life, or if they're an investor, some of the largest investments, and you have fun doing it and make a shit ton of money. Mm-hmm. It's like, yeah, that's it. Sign me up. That was it for me.
Cool.
Brian Kelly, Barrett Financial. I'm a mortgage broker. I think this is coming up on my 4th year, if I'm not mistaken. Time really flies by. Came in the industry as a mortgage broker, learned from mentors that were on the banking side of the business. So they kind of give me the 411 on kind of what to get away from, per se. And with that being said, was with Price Mortgage for about a year before I up and left and went over to Barrett, and I've been with Barrett ever since.
Awesome. Yep. Awesome. Things have changed the last couple of years, huh?
To say the least, yeah. We walked into this industry, I think, is kind of having our heyday. Business was easy to grab. It was all around us. And I think right now is you're starting to separate the weak from the strong, and it's either sink or swim in these markets right now.
Yeah, for sure. So speaking of markets, then why don't we jump into just the local market there? Like how fast things happened, right? I mean, because it was just a matter of weeks, it seems like, that we saw it go from, smoking hot still, right, to almost like crickets, it seems like.
Affordability is down. Interest rates are up 300 basis points. So that's nearly 3% in a matter of 3 to 6 months. It put a whole bunch of people that were either on the fence or actively buying now on the sideline, either for the fact that they don't want that interest rate, they can't afford that interest rate. It's one or the other. And I think a lot of people don't see that it's a key opportunity right now, in that a year or two ago, people were having to pay $20,000, $30,000 over the sales price. You had to waive all of your rights as a buyer. You weren't getting offers accepted, and people were very discouraged. Yes, now the interest rates may be a little bit higher. The affordability aspect may be a little bit lower, but at the same point in time, the selection is much greater. You're able to get homes that you are actually interested in. You're able to get your offer accepted, and you're able to get seller concessions. And if not, get that home at a discount, either or possibly even both.
One of the things that I'm seeing, though, is when before the interest rates jumped up or moved up, you had people looking, let's say, at $800,000 homes, and then the interest rate went up, and those $800,000 homes are no longer touchable for them because they can't qualify for them. Although we know, because the sellers need to sell their house, the prices of the house are probably going to drop just a little bit, but still it's like, okay, going from an $800,000 home to a $700,000 home is kind of a big difference.
There is a big difference too. I was reading something last week in that the average median salary, I think in the year 2000 was 75,000. And I think in 2020, it's around 80,000. So that's only a $5,000 difference.
Yeah.
But when you look at the affordability of a home, it's 4 times as much now than it was back in 2020. Yeah. Right. I'm sorry, back in 2000, right? 2000. So in the course of 20 years, that home has exponentially gone up in value, leaving a lot of people just unable to buy at this point.
Yeah. I saw something the other day. I think it was Raymond James was, they did some study, just crunching the numbers basically, but they were saying that very thing there, that like, 42%, I believe is what they said, 42% of the median household income is what it takes for the median house payment right now. So, those numbers don't work for very many people, obviously.
No, buying it has been cut in half. And for the people that have a good income, those are the people that are still able to buy. A lot of people can still say, well, I could afford that payment. Well, the reality is that the guidelines don't allow you to afford that payment, right? So although it may be realistic in your head for you to obtain that payment, people are no longer qualifying. And what you're seeing is a lot of times active buyers I think that's why we're seeing numbers as far as people dropping out of purchase transactions, is because all these people had a pre-qualification letter and are out shopping.
Yeah.
They find a home, they get the loan estimate out. Oh, my rate's going to be X. Well, I thought it was going to be Y.
Yeah.
Well, now your payment scenario has changed. And I think a lot of people are starting to realize, coming into uneasy economic times, can I afford that high of a payment?
So, deal killer. Yeah.
Yeah, absolutely. And I think what happens is as that rate has gone up, it's not necessarily that house prices automatically drop based on interest rate, but I think what happens is the buyer pool, right, just has to lower their expectation or lower the number that they're looking for as far as the purchase price. So then you just have fewer people in that buyer pool at that 800,000 because they've had to move down to 600,000, let's say, right?
Oh yeah.
So it just kind of moves everybody down.
Well, lower demand. I mean, if supply stayed low, so supply is constant, but if any sort of economic environment, you have demand crash like that, it's going to have an effect, maybe not immediate, but it's going to have an effect on the prices. And people they're not getting the showings they want. They're not getting the offers they want. They're going to be pressured to lower their price.
Yeah.
To what degree, though? I think a lot of people are projecting that they think that home prices are going to crash. Not a lot of people, but some people. And you have to think realistically in that the overall cost of everything now is so much higher, right? So the reality of prices being cut in half like they were back in 2008, you don't realize that today, after the refi boom that we had back during the pandemic, I can't remember the ratio of it, but some odd percentage of 70 or 80% of people now have a 30-year fixed rate at 2 or 3% interest rates. Why would you ever sell your home and move up into something in that your buying power is cut in half? There's just so many different options right now that don't make it. It doesn't make sense for people to sell their homes in a frenzy like a lot of people think that's going to happen.
Yeah.
They think they're going to try to upgrade, but when they look at what's out there, it's actually not really an upgrade for them.
Yeah, prices aren't dropping as quickly as I think a lot of people are expecting them to. And I think right now this year, ever since rates went up in June, people have been on the sideline kind of wondering what's going to happen.
Yeah, what's going to happen.
And I think that the remainder of this year will be quiet now that we're heading into the winter. But really, once the spring and the summer come around of next year, I think there will be a little bit more people kind of making their way out there. But again, you can ask one person one thing about interest rates and another person another thing about interest rates, and you'll get conflicting opinions. I think it won't be until the end of 2023, early 2024 that you start to see a level market in there, and that rates are starting to kind of come down. People are starting to feel a little bit of relief on the interest rates a little bit, at which point in time they may be more motivated to actually get out there and buy.
Yeah. So Brian, you're saying winter is coming?
Winter is here, actually.
Sorry, that's from some show that my wife used to watch. Who knows? Game of Thrones. Yeah. So I think that we might have fewer people decide to sell or move up or downsize or what have you, just based on the rate that they have, right? Because they're kind of, gosh, do I want to get rid of that 2.75, right? But what you will still have are life events. Yeah. Right. So unfortunately, divorce rate is what, like 60% in Maricopa. I mean, you're going to have people that will just need to sell or do something else. And I think agents need to focus on more life events with kind of their approach and what they're educating people on, versus just the standard, hey, I want to be your agent.
Yeah, well, the number of sales transactions is down around 30%.
Mhm.
So, I mean, 70% of people who were going to buy and sell still are. It's that 30%, which is a huge number of people. Don't get me wrong.
Yeah.
A lot of them, they're complaining about the rates now and affordability, but those are the same people, mostly from my experience, that could have bought in 2020.
That's
They
right.
could have bought in 2021, but they didn't.
Yeah.
Because they felt they would overpay then.
Mhm.
And that fear was pretty founded. I mean, we all know how crazy it was. Listings getting 50 offers in one weekend, tens of thousands over list price. The funny thing is that now they've waited so long for the market to go down,
Mhm.
and yet homes are less affordable than they were then.
Yeah.
And so I think when the interest rates go down, which I would predict middle of next year when inflation slows, roughly, I think that huge pool of buyers that have been on the sidelines, a lot of them are finally going to strike.
Yeah.
Yeah, for sure. I saw a video. You guys probably know Barry Habib or at least heard of him, Mortgage Market, or what is he? MBS Highway. Yeah. I saw a video with him last week, I believe it was. And he said that he's anticipating rates being at 5 or under again by the end of first quarter, maybe second quarter of next year. I guess he's anticipating that inflation, they finally might get it a little bit under control going into the first half of next year. But to me, that seems like maybe a little too soon, because I think that it's going to take a little bit longer to get inflation in check than what some people do. But
I think that's a fair saying as well. Barry Habib, though, is very intelligent. He's been spot on with a lot of things. So I don't want to knock, his observation or
sure.
prediction, but I do feel like we're in some little bit of hot water right now economically, and I feel like it won't be until, again, I'd like to be optimistic and say it would be at the end of the first quarter, but I don't think it'll be until further later in the year, realistically. But again, who really knows what's going to come, right?
Yeah,
nobody has
exactly. That's what Joey and I were just talking about. Joey, right?
Yeah.
Nobody really knows what's going to, because you have people on, I mean, if you go on YouTube right now, it's scary to death, because you got so many people that are like, the market is going to crash, 50% drop, all this stuff. And then you got the other side. Oh no, it's not. We're just going to see a little correction. But, the Fed is pretty clear about what they want to do. They need to kind of rebalance the housing market, if you will. And it's going to cause some pain in the short run. So.
Noted. That's what he said. And again, I think you have another rate hike coming tomorrow, I think, right? The second. And so, that the market's already kind of pricing that in. But, I saw something earlier today while I was in the waiting room that somebody expects mortgage interest rates to get to 10%. I said, if we're at 6 or 7 now, we're already up 300 basis points. I think another 300 basis points is really a stretch. I think that's just a negative train of thought in that, it's kind of like the fear aspect. Like a lot of people think home prices are going to come crashing down 50%. Yeah. That same mentality thinks interest rates are going to go to 10%. Right now, half the homes aren't even affordable like they were, 6 months ago, 3 months ago. If you put interest rates at 10%, I mean, you're killing the economy at that point. I don't think the feds would actually do that much harm to the economy that quickly. You've got people, I think, in the central bank and the European Union too, that are talking about stop, bringing up the rates so fast, because you're going to create that recession, not just in the United States, but economically worldwide.
Yeah, for sure. I was doing some math the other day. We saw like a 40% run up in about a 2-year period, maybe, or maybe a little less than the 2 years. It only takes a 29% decrease to be back down to where you were before that 40% run up.
Are you talking about the appreciation levels? Yeah. Massive appreciation. He could, Jordan can attest to that. I think we saw appreciation levels that nobody has seen before. So to expect that your value is going to drop 10%, I'm okay with that. If I bought an investment 2 years ago and it appreciated 30%, but it just dropped 10%, I'm still netting 20%. And I promise you in another 10 years, it's going to be tenfold higher.
Absolutely.
So
I bought actually here in South Scottsdale. I bought in September of 2020. And I paid over list price for it,
Mhm.
and I bought in the low fours. And that same property now, earlier this year, I could have sold in low eights, but now mid sevens is kind of where I'm thinking it's at. So, I stress myself out and pull my hair out over the fact that I've lost maybe 50, 60 grand, and that I could have possibly made, because you don't realize that until you sell it.
Yeah.
Or should I just relish in the fact that I've gained 300 grand in equity in 2 years?
Or do you sell it since you've been there 2 years and get that money tax free? Yeah.
That's right. And then
If
get
it's a primary, that is.
7%.
And then get
Mortgage.
7% rate.
Yeah.
Oh, just rent for a while. It'll come back down. No, I'm just teasing. So let's talk about some strategies then that you guys are talking to clients about, as far as how to maybe get in at a lower rate, right? So I know you were mentioning like the buy down strategy. Let's talk about that a little bit.
Yeah, I think both lenders and real estate agents will attest to right now that the 2-to-1 buy down program is wonderful. It doesn't help us qualify more people, because we still have to qualify them off the note rate that it is today. But when people talk about dollar for dollar savings, you're getting, the seller credit. You're getting a seller to give you a credit towards buying down your rate. And I mean, we're effectively saving thousands of dollars, if not tens of thousands, depending on how big your mortgage is each and every single year. So,
do those typically have prepayment penalties?
No.
Okay.
That's the beautiful thing. I think originally when I first got in and started hearing about them, I thought it was a retail gimmick for lenders like Quicken Loans and Loan Depot.
Yeah.
Because they have higher interest rates, for them to stay competitive out there. And then I saw the wholesale channel bringing them in, and I learned more about it in that if the money goes into a so-called escrow account, and they will say rates optimistically come down in a year, and you refinance, you don't lose out on that money. That money in that account goes towards a principal pay down on your previous loan balance. So it's not like you're losing that money. Whereas you can spend tens of thousands of dollars to buy down your interest rate, and effectively for 1 point, you only get 0.25% of a rate discount. Whereas if somebody spends that 2-to-1 buy down, you're getting a full 2% lower for the first year and a full 1% lower for the second year. It dramatically adds up, and it makes a huge difference on the overall payment.
And concessions, I'm sure concessions are going through. I mean, buyer or sellers are paying the concessions. Are the majority going to the 2-1 buy downs, or are they able to cover their closing costs as well? Are you seeing that?
Your seller concession can only go towards, you can only utilize a 2-to-1 buy down with a seller concession, right? I couldn't use my own money, or Jordan, being a real estate agent, couldn't contribute any of his own commissions to making that happen for our buyer, right? But I think, Jordan will attest to, his clients, what is favorable to them, in that I think we agree that the 2-to-1 buy down is a huge strategy right now in saving people a ton of money.
Yeah.
I think educating the client on that is paramount for the agent too. I mean, you have to have a good relationship with the lender, and kind of almost like have a tag team meeting with the client and say, look, here is the overall strategy. We're asking for these concessions. Don't go out and buy a car with it. This is what this is going to be used for, and kind of explain the purpose of it, the benefit to them. And a lot of times talking to the selling side too. I think a lot of agents and sellers, all things being equal, they might actually even prefer to give a concession versus lower the price. The agent, they get more commission slightly if they do that versus lower the price. And it's also a point of pride by saying we didn't have to lower the price by that much. We just helped them with their rate.
And I'm curious, how about appraisals? How have they been coming in all right?
For what I've seen, I haven't seen any that have been coming. So I think during the pandemic, when everybody was buying, you're getting a lot of appraisals coming in low. That's why you have the appraisal waiver aspect, right? You need to pay the difference. Now that sales prices are kind of coming down a little bit, I'm seeing appraisals just right at the value that they're supposed to be. Even if we're getting creative on the financing and say we need to use that 2-to-1 buy down, and they just drop the price $6,000, we'll get creative and say, no, let's go back. We'll pay the original asking price that you had it for, so you can gross up that. And then instead, we want the seller concession. So the seller will still net the same, except for we're able to use those funds in a much more strategic way for the buyer.
Yeah, makes sense.
Appraisal. I've seen a few appraisals actually come in high. Because especially if you're in a community where there's not a whole lot of really good recent comps.
Mhm.
They're looking back 3, 4, maybe 5 months
Mm.
back when the market was a little bit different.
Yeah. Yeah.
And so, I mean, some people are buying right now. And again, qualification and affordability is really the issue, but sometimes they're walking into equity like
Mhm.
on day one.
Yeah, because I was thinking of refinancing, and I was speaking with the lender, and it was a more of a bridge loan, investment loan, and they said, okay, well, with the appraisal values, we're going to have an appraiser go out there, but we're going to have them subtract a certain percentage lower, saying, you know, I can't remember if it was 5% or what it was. If it comes in at this, we're going to look at it at this,
What
which
was
is
the
kind
rationale for that one? Do you know?
because they're looking at the trend going down.
Ah,
And this is for investors, so it's a little bit different. It's more private money than anything
Okay.
else. So, but they probably don't do that at a regular brokerage, right?
we still have our brokerage. We have access to hard money lenders like
Okay.
Cat Fund One and some other ones. That's the
Mhm.
beautiful thing about the broker side is that we've got over 100 lenders to work with,
Mhm.
and we're not limited. So a variety of lenders to do bank statement loans. Whereas, you know, if you're working with one individual company, yes, they may be able to offer bank statement loans, but the reality is they're going to broker out that bank statement loan to their preferred partner that they work with.
Mhm.
But what if they can't get the loan done for you? Then you're stuck. Whereas with us, if one lender can't get the loan done for me, I can easily pivot to 10 other lenders who offer the same bank statement loans and tell them, this is what I'm running into. Do you have that same overlay? Yes or no? If yes, you move on to the next.
Mhm.
Eventually, you do find one that doesn't have that overlay. And I think that that's kind of contributed to the success in that originally I'd call agents and try to solicit them as far as working with a mortgage broker, as far as the value aspect, better interest rates, no lender fees. And I found that they didn't really care about that.
Mhm.
They want a lender who they can communicate with and that knows that when they hand them the deal, they're going to get the deal done. So I started realizing, okay, if they're worried about their money, let me help you close more loans that other lenders can't. And so that's when I started calling them, informing them about the non-QM options, you know, the no income docs that we have, or no income doc loans that we have, the hard money loans,
Mhm.
and trying to be a resource to these agents
Yeah.
in that when their deals don't go through with their preferred lender, that they do have an outlet, and at which that's an opportunity for me to kind of shine and show you what we can do.
Okay. And you guys do bridge loans as well.
Bridge loans, everything. Oh yeah.
Perfect.
And non-QM is pretty cool. I mean, especially after the pandemic and where we are, especially, there's a lot of entrepreneurs, self-employed solopreneurs out there
Oh yeah.
who, for whatever reason, they're still renting because I think they have it ingrained in their mind from 1 or 2 conversations. I don't
Good
know
point.
when they had those. They don't think they can qualify to buy a house
Mhm.
because maybe they're not claiming enough from their taxes or you know, several reasons. But I think non-QM really educating the entrepreneur and solopreneur, that can be huge. I feel like there's obviously some tax benefits with home ownership they're not taking advantage of.
Yeah, you hit the nail right on the head. You've been an entrepreneur, I think, ever since I've met you, from before you're a real estate agent. And I think that a lot of times we have friends that they do very well for themselves, but they just continue to keep renting. And I think the reality is because it boils down to what's on their tax returns, right? Being self-employed, you take advantage of Uncle Sam, you write off your income, which is perfectly fine.
Yeah.
But you come talk to somebody, me like a lender, and we look at the guidelines and we say you don't have any income.
Yep.
So having those options available, like bank statement loans and non-QM products such as like a DSCR loan, which is there's no tax returns involved, no bank statements,
Mhm.
no nothing like that for any kind of income documentation. Those types of loans are going to get people into a home, right? As far as the home ownership, and Jordan's hit the nail right on the head, is it's not about, I mean, yes, you're saving money, you're building equity, but when you're self-employed, you're all looking for tax write-offs.
Yeah.
And when you own real estate, that's a major tax write-off,
Mhm.
especially once you start owning rental properties. You can start capitalizing on the depreciation aspect, and you can have so much in your write-offs that it just pretty much washes out your income.
So Brian, are the I'm wondering how much of a difference in rate, if like for a bank statement program, for example, with 20-25% down or what have you, is it fairly competitive still, or?
About when you say competitive in comparison to like a normal traditional 30-year fixed?
Yeah, I mean, are we talking a point higher, 1.5? I mean, what's kind of a?
I'd say about a point to 2 points higher, depending on your credit score. Obviously, if you have a low credit score and a low loan to value, and you only want to put 10% down on the bank statement loan, you're going to have a higher interest rate, maybe about 2 points higher. But again, keep in mind that on these bank statement loans, you can do just 10% down and not have any PMI, right? Whereas if you do 10% down a traditional loan, you're going to have a lower rate. Yes, but you also have PMI. So when you
Right.
look at the payment difference, a bank statement loan will always be higher, but how much higher is it really? It's not that much higher. And keep in mind, again, mortgage interest is tax deductible. So at the end of the year, you get a little sheet from your lender that says that you can write off this much. And if you had an 8% interest rate as opposed to a 6% interest rate, guess what? That's just more tax write-off.
Got it. All right. As long as you're itemizing.
No.
There you go. As long as you itemize it.
As long as you're itemizing. Right?
I don't
To
want
get the write-off.
That's not a
Smart.
CPA.
Outsource that. Yeah.
Oh, sorry. That's just my brain thinking.
I'm all for it though.
Hey, how about arms? Are you seeing a lot more of those?
I am, but I talk clients out of it.
Okay.
In that, ARMs, adjustable rate mortgages, yes, you're going to save a little bit, but you put yourself into an unpredictable situation where interest rate's going to be in 5 years if you don't end up refinancing. A lot of people, what happens if you get into that loan and then 2 years down the road, 3 years down the road, you can't refinance because you're not in a financial position. All of a sudden, interest rates are going up at that point in time. That's what kind of put homeowners in trouble back in 2008 is they had these mortgages that were just kind of adjusting on their payments so frequently that people couldn't keep up with the payments. Instead of the ARMs, I'm a big advocate of the 2-to-1 buy down, or don't spend any money on the interest rate if you can afford the payment right now and go along with it for a year and a half. And I promise within about 2 years, you'll be in a position to refinance and not be spending $10,000 on your points, right? Or, you know what I mean? All this money paying down your interest rate for the fact that there's a break-even point. So you spend 10 grand to save this much. Well, when is your break-even point? In 5 or 7 years?
Yeah.
I promise you, you'll refinance out of the loan before then, and all that money is no longer effective.
Yeah. Are there also 7 and 10 year arms?
5,
I mean,
7, 10.
Okay.
5, 7, 10. And again,
7 and 10, do they allow you then to qualify off of the 7 and 10 actual rate versus a 30-year?
yeah, on an ARM, you're always going to traditionally qualify for a certain amount higher than the actual note rate because they take into they take into account the fact that the note rate can adjust later on down the road.
Okay. All right. How about Jordan, maybe on your side? I saw on MLS, now I'm out here in Missouri, Southwest Missouri, and I saw a new listing go on the other day. Well, I guess not new. I guess it was a price reduction. So I saw it as a new one. But they were offering seller financing. Are you seeing any sellers offer to do that in this market? I mean, let's say somebody locked in at 3%, right? And rates are at 7% now. I mean, there's some opportunity there, right? To build an arbitrage for somebody that wants to write their own note for a buyer.
Absolutely. Yeah. Actually, I have a seller right now who is offering seller financing.
Really?
Yeah. He's an attorney, his idea actually, but it's brilliant. I actually did a YouTube video on why that could be a good option for sellers. Now, most sellers, I would argue, maybe are not in a good position to do this. But if they do have the wherewithal to offer seller financing, it does create some really cool opportunities. First off, you can basically replace the bank and charge whatever interest rate you want. So he's actually offering 5.5% on the seller financing. So there's a few homes also in this community that are pretty good comp, similar price. His is now much more affordable than those are.
Mm-hmm.
Yeah.
And then in terms of, again, I'm not giving tax advice, but he's realizing the income over time as he receives those payments. And so we think about capital gains and taxation. Well, politics here in Arizona are expecting a little bit of a red shift.
Yes.
And so realizing that those taxes over time is going to put him in a lower tax bracket, pay less overall taxes on the income he's receiving from selling that home.
Yeah.
Got it.
That's his case. I'm not saying, I'm not giving tax advice.
Yeah.
But it is something worth looking into.
Absolutely. Well, I just think that with the rates the way they are and unpredictable for the next at least six months or longer, it definitely gives an opportunity, right, to do the seller financing. I mean, as long as somebody doesn't need all that equity out of the house, if as far as selling it. But I think most people seller finance probably want at least 20% down, 25% down.
Right.
Like that.
I think his minimum was it's a ballpark round number, but it's around 15%. Will not take less than that down, just to show that someone is serious about it.
Yeah.
But the area where he is, it's really a little bit higher end homes for the area. So typically you're not seeing first time home buyers there anyway. People are coming in selling a previous property, coming in with equity, that is usually more than enough to cover his, whatever down payment he needs.
Yeah. But I think it's a great topic, Jordan, for you and other agents to really talk to sellers about or potential sellers about, because now it separates you, because probably not a lot of real estate agents would, no knock against agents necessarily, but I mean, they just don't study that type of stuff
think outside the box,
coming up with the right strategy,
Yeah, for sure. I think it's definitely, if a seller has the wherewithal to do it and they're not scared, worth looking into. 100%.
Yeah. So where do you guys see things going? I know we kind of talked a little bit about maybe it being a little quiet the rest of this year, but what are you guys doing differently over the next couple months to get prepared for the new year?
I'm expanding into wholesaling, investing, REO properties. Anytime there's a contraction, right? And again, people have great rates. They're not going to want to sell and get out of that and go to a higher rate. But during hard times, people might be accepting lower offers for their home. They might be wanting to downsize, move in with family. And so I really predict, at least until things normalize next year, again, that's also a prediction, but at least until things normalize, I'm seeing, I think investors and wholesalers are going to have a field day. I think that's going to expand a little bit. People that want quick cash now, maybe they bought more than they need during the pandemic. They want to downsize. I think investing and wholesaling is going to be taking off over the next year.
Yeah, I know there are a whole bunch of wholesalers who are sending me properties, a bunch of them. And, but still, when I'm looking at the ARVs that they're sending, it's like, no, it's still a little too high.
Yeah. Wholesaling is tough right now because people were doing the fix and flips and sky was the limit on what you could sell it for. Yeah. Now the problem is that not only do you have to flip it, but you don't know where the market's going to be in the next month or 2 months. And then on top of that too, because I do a lot of hard money. My guys, once you borrow the money, you're paying interest only.
Yes.
Month after month after month. And so if your property is sitting, not only are you having to reduce the sales price, which comes off your bottom dollar, but now you're paying interest only to your hard money lender. That's eating up your pockets as well. Right. I think wholesaling too is going to die off a little bit as well, because at the end of the day, until you have more buyer demand picking back up, those people aren't going to be able to flip properties as quickly. So my last investor is out $25,000, I think, on his last flip, based on the fact of not being able to get it.
No, he's lucky it's only 25,000.
Hey, I mean, he's used to racking in 25 on each deal, if not even more.
I wanted to clarify too, though. I think flipping is going to see some hard times because of the market. I'm talking about buy and hold.
Yeah.
Especially long-term rentals. And here, I'm sure
even short-term rentals.
You said you're in the St. Louis, Missouri area, or
Springfield, Missouri, Southwest Missouri, Ozarks.
Missouri is growing pretty quickly too, right? It's one of the areas people are moving to.
Yes, a lot of people moving from like California coming to Missouri to be able to shoot guns and stuff out in the woods.
Yeah, same thing here, except desert. But people are moving here. I think around 300 people per day on average.
I heard 250
per
day. Yeah.
A lot of people every day, and with people holding onto their equity and not selling their houses, they're going into rentals. Most of them, especially in this uncertain time. And so rental rates are still rising.
Yeah. Well, even short-term rentals are really good. I mean, that's kind of because I have 3 of them that were stuck in that got caught in I can't sell it for what I need to. So we're going to do the short-term rental.
Especially here. I mean, people still want to go out and travel and have fun, but maybe instead of going to, Hawaii, they want to save money. They'll go to more of a domestic destination like Scottsdale.
Yeah. With Super Bowl coming too. A bunch of.
There's going to be a lot of business in town.
Oh yeah, big.
So it's interesting when I asked like what you guys are doing to get ready, and Jordan, you started talking about some opportunities and things. My phone is sitting right here, and I got an email notification from CDPE, which is the Certified Distressed Property Expert designation. Came through as soon as you started talking about
the wholesale property came in.
What's that?
The wholesale property that came in?
No, it's I don't know if you guys. Well, so in the last housing bubble crash, what have you, back in 08, 09, CDPE became a really hot designation, Certified Distressed Property Expert.
Okay.
And it's kind of making its way back now because they're preparing for, people having to make some tough decisions maybe this next year. So as soon as you talked about it, that popped up in there, and I'm like, perfect timing. But
Yeah. I feel like people who can buy and hold now, especially if they have cash, which is good for institutions, maybe bad for the little guy. But if someone can buy with cash or get a bought down rate and somehow end up cash flow positive now and hold it, when rates do go down, I don't see rents going down.
Yeah.
I think they'll be able to improve their cash flow, either refinance out or sell at a profit later on down the line.
Yeah.
I think buy and hold right now is, the buying strategy that investors should look at.
Yeah.
I think real estate in general. I think if you have the mindset of anything different, you kind of set yourself up for failure. In that, if you just look at home prices, what they were in 1990, and then 2000, and 2010, and 2020, there's an obvious trend there. And I think the mindset of I'm going to buy this, get rich quick, because we saw 20-30% appreciation in 2020 or in 2021 is not really realistic. But again, the buy and hold strategy never can let you down in real estate ever.
Yeah, for sure. Anything else you guys want to share with the agents that are watching or listening before we move to the final segment?
Off the top of my head,
I think we covered.
I mean, I know we covered a lot, so
I don't want to give a sales pitch today.
Well, any agents that are watching and listening, if they want to get a hold of you, Brian, how do they do that though?
I'm always available, whether you want to call, text 602-622-1145. I also have an online website you can find me at if you want to fill out an application online. It's www.briankellyhomeloans.com.
Yeah. And one thing I wanted to add too is agents, especially across the country, should find communities, because even though transactions are down nationwide, 70% or so they're still looking and they're still making moves, and agent to agent referrals is something I'm definitely growing over this next year. I'm reaching out to California and New York, all the places that feed a lot of people to Arizona. Yeah. So I'd say, I mean, you being in Missouri, anyone watching this out of Arizona, feel free to shoot me referrals. I drop 35-40% on referral fees. So, it's something I'm really aggressively looking at.
Wow. Yeah. And you said you do YouTube videos too, or no?
I do. Yes.
Okay. There you go. That's a good way to do it too. Cause we interviewed somebody on the show here probably 4 months ago now, maybe. She's grown her YouTube channel so much that now she's generating about 30 referrals per week from her live stream that she gives out to other agents.
I believe it.
Yeah. YouTube crazy.
Powerful.
What's that?
YouTube, pretty powerful.
Yeah, absolutely. Absolutely. All right, guys, are you guys ready for the rapid fire?
Yep.
Yes.
All right. So big shout out first to Kinder Ashford with Security Title getting you in here. Kinder's a great sales rep over there for sure.
Yes.
Also to our sponsor, Security Title Agency and Fidelity National Home Warranty. If you haven't tried them, give them a shot. And you guys, let's get in the ring. Here we go. Podcasts or YouTube videos? Which would you rather?
Yes.
YouTube video.
Yes.
Yes.
Both? That's good.
You record the podcast, upload it to YouTube. 2 birds, 1 stone.
There you go.
There you go. How about pizza or cheeseburgers?
Burger.
I was going to say, by looking at the guns on you guys, you probably don't eat a lot of junk food.
Yeah.
I do.
How about Apple or Android?
Ooh, Apple.
Android's a red flag.
No.
Favorite activity outside of work?
Work.
I
don't know anything.
Jiu-jitsu.
Jiu-jitsu.
Oh, there we go. Gi or no gi or what?
I do no gi. I've done some gi, but it's not as, for me, I feel like, because I work in a suit a lot. So I feel like I'm actually fighting somebody in my work suit because they're grabbing lapels and
don't wear your tie, right? Oh, that's funny. How about, would you rather drive electric car or gas car?
Gas.
Now, electric, depends on the car. I mean, there's a difference, big difference between a Tesla Model S Plaid and a Chevy Volt.
Oh yeah, big difference. They're not in the same category, are
I'm
they?
okay paying to get the extra gas right now. It's not that bad.
Yeah.
Not yet.
All right. And last one, favorite superhero.
Favorite superhero. I like the Punisher. He's kind of an anti-hero, but he gets things done his way.
Yeah, I've seen that.
It was Spider-Man since I was a kid, but
Yeah, that's awesome too.
All right, guys. Hey, thank you guys so much for being in here, sharing this information. It's been a good show.
Yeah, great show.
Truly appreciate it.
Yeah, absolutely. Thank you guys again.
Yeah, for sure. Hey, agents, until next time, we will see you later. Take care.
All right.
All right, good job, guys.